Good morning and welcome to the Saxo Bank Morning Call. It is Friday, February 15th, and we have a lot going on in markets after some pretty interesting data out of the U.S. yesterday. That ex-auto and gas December retail sales from the U.S. down at minus 1.4% month on month. The market was not prepared for a figure like that, Ole. And we're seeing some very ugly price action in some markets, but actually I'm a bit surprised we haven't seen uglier price action. If we look at actually, I'm on the wrong slide here, but we'll get to it. If we look at the chart here on the S&P 500, we're seeing that stay with me, that blue line, 200-day moving average, we've talked about this for many of the last sessions. We tried above it. I think this latest price action pushing us back below. And I would argue with the very ugly data point like this, maybe the U.S.-China trade negotiations hitting a weak spot as well. This becomes the key pivot point, and I think at least the risk, I'm not saying we're going to launch full scale back into a risk-off mode testing of the lows. Those are awfully far away now, but I think this could mark at least a temporary market top, if not something far worse. If we look at the action in Europe, we saw that terrible GDP print from Germany yesterday, 0% growth quarter on quarter, and it only plus 0.6% workday adjusted for year on year. And just note the last bar there, that candlestick, it's engulfing of the previous day's action. What a candlestick enthusiast would call a marubozu candlestick. In other words, there was really no price action above the opening price, which was the high of the day, and then the closing price, which was the low of the day. So pretty ugly price action. We're about to open now, and the U.S. futures overnight down some 10 to 15 points. So I think we're going to be starting off on a weak footing there. Cross markets, though, it's not a completely sort of unified picture. The oil market's not really playing ball with this risk off right now, and the ugly macro data, China negotiations, etc.
Now it seems like the market's really struggling to focus on more than one thing at a time. And this week the focus really has been the dwindling supplies coming from OPEC and Russia, and that's been providing some support. But as we can see on some charts later, it's really only Brent crude that's breaking or making an attempt to break higher. WTI is still struggling, and it's because of something about the quality of crude matters right now.
Okay. We'll be covering that later. For now, let's look at how this risk-off, introduction of risk-off back into the market is being felt in FX markets. We look at yen crosses, of course, the usual suspect when you're seeing risk-off. And, of course, with that very weak U.S. macro data, also the jobless claims coming up. And we're starting to get a few weeks in a row where those jobless claims are not looking good. So we'll be keeping an eye on that increasingly as the weeks go by. But lower U.S. yields, risk off, and we're seeing yen crosses roll over, even dollar yen, despite the dollar looking relatively firm elsewhere. So I think, again, sort of proxy of risk appetite as well in foreign exchange markets when you have that 200-day moving average around the same levels for the cycle as with the U.S. Equity markets. So it looked like a top in place for now there until proven otherwise. I look at Canada versus the Japanese yen as well, the next chart. And we see that there, the local price action never went to the new highs. That's sort of repeated across a number of yen crosses. So I think you can take your pick if you want a bit more beta exposure to risk off and potential yen upside, something like CAD yen. I would argue even Euro yen, but especially the EM trades, emerging markets, to me have been a bit of a head scratcher how aggressively they've extended here. And it'll be interesting to watch if there's maybe a bit of a flip side, the carry trade, so strong yen and then EM getting exceptionally weak if we are going into a risk off here, which I think is a prominent risk. Now, Ola, back to your argument on oil markets. You've got a slide here on the left, some pretty interesting stuff on the U.S. side, import data.
Yeah, because what OPEC is doing right now is pretty clever, because they want to basically to be visible that they are cutting production, and the best place they can do that is by cutting exports to the U.S. because we have weekly data. And you can see that on those charts on the left, the top is the total imports, which has dropped to close to 6 million barrels a day. You can see that's well below the 5-year average. And if you just look at the crude oil imports from OPEC, it dropped to a million barrel last week, and both imports from Saudi Arabia and Venezuela, they are now teetering on record lows. So that's really having an impact on the market. But what's happening then in the global place is that the kind of oil that they are cutting production is the heavier quality oil, and obviously Venezuela is a big provider of that as well. That basically means that the middle barrel, as it's being called, is now in short supply, and the light barrel, which is primarily U.S. oil, is in oversupply. And that's why we right now are seeing that the WTI is struggling to keep up with Brent on this move higher. The spread is widening close to $10. Brent is moving up, but I think what we still really need to be focusing on is the macroeconomic data, because we have seen those weakening. both OPEC, IEA, and EIA in their weekly or the monthly reports, they're still not making any downgrades to demand this year, and that's keeping the market supported. But I think we need to stay on our toes in terms of of demand potential being impacted.
And remarkable to think the U.S. getting that benefit of the cheap energy prices relative to the rest of the world because of the cheap shale gas and the cheap local crude grades.
But as long as the refineries can actually use that oil, and that's creating some bottlenecks right now. This light oil that's been coming out of the shale oil fields, that is not all refineries that can utilize it, and that's creating this oversupply in the U.S. and the lower supply elsewhere.
And then on gold, I think really important to point out what's going on in gold in a broad sense. You're seeing gold really outperforming across the board on all currencies, and I like that you brought in a chart of gold versus something else besides the dollar, just for perspective.
Yeah, because again, we've seen the dollar strengths now over the past month, and gold is actually holding up really well. We're holding above the 1300 level. That basically means that gold is moving higher against some of the currencies that have been weakening against the dollar. Then the example here is the euro, which is now trading at gold euro in euros trading at a 22 months high. And if you see some of the other currencies, it does indicate that it's not just a dollar play right now. It's also there are some concerns which are continuing to attract demand for gold, and we have not really broke. As long as we stay above, I'll say 1275, then the outlook looks still supportive there.
I would suppose the key concern for gold or the key boost to gold would be provided by the return of the central bank printing press, and that's maybe something supporting it.
Yeah, and going forward, now we had a very bad number, as you mentioned yesterday in the US, and overnight in China weren't good either, and that does basically mean that the gold market is looking for central bank support, and we have seen in the past what kind of positive impact that has had on the metal.
Great. Now let's go to our calendar outlook for the rest of today and next week. We've populated the next week highlights. UK retail sales data, I can't imagine that's particularly strong, but we're all waiting for Brexit news there. The latest situation for Theresa May is she's seen her mandate as she's heading back to the EU for negotiations, weakened further by what looks like an ill-advised move with a vote in Parliament that has weakened her ability to have that leverage. It's a pretty complicated motion that had two sides to it, and it allowed her own party to revolt, and so she's going to go into negotiations with a very weak mandate now that her own party has rejected this admittedly non-binding vote. And I think what key on the calendar here, what I've put in for the longer term event risk is that February 27th date, where it looks like we'll see a motion in Parliament with a specific bill which would be binding to avoid a no deal. So essentially Parliament taking more control over the process. So rather interesting there. I think the U.S. data highlights, not so interesting today, but that potentially if that industrial production figure is exceptionally low, could garner some interest, especially I think there's a risk that it is to a downside miss because of the oil production in the U.S. Being affected by lower oil prices. And then next week, just highlight briefly the FOMC minutes on Wednesday. It'd be interesting to see the debate on the degree to which the market is overpricing or underpricing, how profound that turnaround to the dovish side has been by the Fed. We have the flash February PMIs out of Eurozone will be very closely watched as we're all talking about the risk of a Eurozone recession, potentially already coming up in a quarter or less. And then we have, I've highlighted on Friday next week, the Fed's Clarida. He's on the Board of Governors. It'd just be interesting to see the topic of his speech, which is on Fed tools and communications. So it'll be interesting to see what the Fed's Clarida has to say there. And then, of course, we're all getting very tired of the headlines linked to the U.S. and China trade negotiations, that theoretical deadline on March 1st. But talks, this latest round of talks where we have the U.S. Trade Representative Lighthizer and Secretary of Treasury Mnuchin in Beijing, those have wrapped up today. So, and it doesn't sound like we've seen promising headlines. This whole forced technology transfer issue is one of these key sticking points, and I think I would be surprised if we find a long-term solution to that, and whatever deal shapes up out of these negotiations. That's it for this week. We'll be back next week with the Saxo Bank Morning Call. Thanks for joining.